We had a beautiful green day in the stock market today, perhaps in anticipation of St. Patrick's Day coming up a little bit later. But my oh my, we had 88% of the market higher here today. But was the 2% full move enough to actually be trend changing? And that's where we have a lot more question marks, but at least it's a start. We also saw some promising activity out of foreign developed markets. And I also wanted to concentrate on one sector in tonight's video that I have not been talking about recently, healthcare, that seems to be kind of emerging from its own slumber. Then we'll get into our trade application example. I wanted to focus on a beaten down area of the market today. Commodities really tumbled, and there was one stock in particular that fell so hard that it has an oversold cluster signal. So I thought today might be an interesting day to do a put sell on it. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 15th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below in the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever these videos get posted, and it also gives you a heads up as to which stocks are giving you overbought and oversold clusters within the S&P 500 at the bottom of those emails. We're also heavy users of Twitter. If you're not doing so already, we would encourage you to follow us. My handle happens to be at Brandon Van Zee. Of course, we'd want you to follow David and also the Market Scholars handle there as well. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as I was joking on Twitter here just a moment ago, this is the market's version of pouring the dye into the Chicago River. Perhaps that joke doesn't mean a whole lot to those of you that are watching this from outside of the United States, but one of the routines and traditions that we have here in the U.S. when it comes to St. Patrick's Day is to pour the green dye into the Chicago River. And I've never seen it with my own two eyes. I have seen it on the internet. It looks pretty cool. Anyway, you can see here that in anticipation of St. Patrick's Day, the stock market gave us a whole lot of green. If I was looking at it the right way previously, it looked like there were about 88% of the stocks in the S&P 500 that closed in the green today. In fact, it makes the one segment that stands out in the red very obvious, and that's, of course, this block right here in the middle where it kind of says energy, where I'm circling my mouse right there. And in case you didn't see yet, energy prices have really pulled back strongly in the last couple of days. And so today we actually saw oil prices back below $100 a barrel. Remember, it wasn't too long ago, maybe a week or so ago, it was touching $130 a barrel. So we are talking about extreme volatility in the commodity world. And so that meant that, that particular segment of the market kind of slipped here today. And all of these other stocks benefited from that, right? It's kind of been one of those types of, bifurcated markets where it had been energy strength, and that was pretty much about it. And most of the rest of the stock market really struggled unless it had something to do with commodities. And today was just a reversal of that same dynamic, where today we saw energy stocks getting hammered and the rest of the market kind of getting the benefit from that. But of course, that doesn't necessarily mean that we're out of the woods yet. We still have a lot of work to do in the charts. We'll take a look at that a little bit later. But it was a very unique day, to put it mildly, where we saw so much green across the board, and just the only patch of real consistent red on the heat map here was in the very area that had been the strongest area in the market up until here the last couple of days. So Exxon and Chevron really struggling today. Exxon down 5%, Chevron down 5% as well. You can see some of the rest of them there as well, mostly in the red. Otherwise, lots of green, and in fact some bright green, including NVIDIA. One of the holdings we have in one of my Monday classes was up 7% here today. Not to be outdone, AMD was up nearly 7% there. We saw Monolithic Power Systems up 9%. We saw Micron up 5%. So a lot of those semiconductor related areas really doing quite nicely here today. And of course, the big beasts out there, Microsoft, Apple, Alphabet, they all did pretty well here today as well. By the way, I did shut down that Microsoft bear call spread here today in addition to a bunch of other trades. Today was a little bit different than my normal post to the Telegram for our premium members because I shut down a whole bunch of trades here today. Normally I wouldn't do that, but I'm going to be out of the office for the rest of the week. So this is my final presentation of the week, and just a friendly reminder at this point as well that I won't be doing this market outlook video on Thursday because I will be out of town and away from my normal workstation. So I think Microsoft would have been just fine, but just because we have more volatile market environment that we're working in, we've got the Fed announcement tomorrow, we've got an options expiration date on Friday. Figured it would be better play it safe in this particular case. So I shut down a bunch of the trades here that we had some expirations coming up on, including Microsoft. But that ended up being a big winner there for us, as did our Danaher position, which was a long put spread, so benefiting when the market went down, just like what happened there with Microsoft. So just a friendly reminder that, when you're more agile in the marketplace, you can have the luxury of putting on more bearish trades, and that can benefit you when we've had months like we just had here recently. Some of you might have saw my tweet last night that showed that within the first 48 days, trading days of the new year, this year of 2022 is actually the fourth worst year on record. Just to put that into perspective of how bad things have been. I think a lot of us kind of feel it because we look at our portfolios often enough and understand that the markets have been under pressure, but that kind of, puts things into perspective. Fourth worst start to the year in history. And so today was welcome news as we saw a lot more green showing up on the board. But as I mentioned before, we've got work to do. So let's go ahead and take a look here at some other information over on the Thinkorswim platform. Here is our visualize area of the Market Watch tab. Just to confirm for you, we had 448 stocks within the S&P 500 close in the green today. So that was good for about 88% of the components closing positively here today. And of course, in anticipation of St. Patrick's Day, hopefully we have a couple more green days on the horizon here in the next couple of days. We'll have to see about that, but at least one day showed us some love. Let's go ahead and also take a look at our charts. And you can see that today was a day that we were up more than 1%. So I like to show you this particular chart, 6D, on days like that. By the way, most of you that are premium members that either attended my dividend growth investing class here earlier today or at least saw the telegram that I posted later on in the day will be aware of this by now. But in case you're a premium member that hasn't gotten a chance to check those sources yet, be aware that I did have 3 chart updates here today. Charts 2A, 2B, and 2C. Those are the charts that I use in my dividend classes. And remember, especially with the dividend stair-step charts, I need to run those calculations off of the platform once per year, typically within the first couple of months of the year, just like is the case here this year. And then I need to kind of rebuild in those results of those calculations into the script. So most of our custom charts that we offer you guys that are premium members, remember we have over 50 charts, the vast majority of them are automatically updated and they don't really need to be adjusted over time unless you add some sort of a feature to it or something like that. But in the case of the dividend stair-step charts, that's one of the rare ones where there needs to be something that's done outside of the normal Thinkorswim charts that needs to then be fed back into the charts. And so it's a long process. I do need to make calculations for over 700 stocks, and that includes the average high yields and the average low yields. So technically there's about 1,400 calculations that I'm doing off on a separate spreadsheet. They have now been built back into the dividend stair-step chart. So again, feel free to check the telegram for additional information there or watch my dividend growth investing class from earlier today. But those updated chart scripts that all of you premium members are entitled to can be found under the tools area of our website in the premium resources area, and then going to the Thinkorswim chart links tutorial area. And remember, our our charts all have a date in them. So for instance, up here on chart 6D, it says 1/15/21. That tells you the last time we updated this particular chart. But if I were to go to chart 2A here briefly, just to show you how this would work, because I know it's easy to forget about this stuff, so it's helpful for me to remind you every so often when it comes to the forefront. Up here on chart 2A, you'll now notice on my screen it says 3/15/22, which of course is today. So today was the day I updated it, and if you have a day that is different than that in your chart 2A, then that means that you need to go through the updates and import the new shared links there. So just a friendly reminder on that, just in case you weren't catching it in the other two areas that I mentioned it here earlier today. But let's go back here to chart 6D. And as we're looking at chart 6D here, you'll notice that we have this nice big green bar here that stretches out and above this orange horizontal line. If you're newer to looking at this chart, let me just get rid of this. That kind of clouds the vision a little bit. If you're new to looking at this particular chart, that orange line represents a 2% move, and you can kind of read these labels up above that middle area to help you help remind you of that situation. So these yellow lines would be a 0.5% move. The blue lines represent a 1% move. The orange lines would be a 2% move, and then the really big and exaggerated days might be those pink lines with a 3% move, and you'll notice that they're on either side of the zero line, and that's for good reason. The bar that moves lower, that is painted in red, would be negative days. The bars that are green and rises are positive days, and so the zero, if the market happened to be exactly flat, would be exactly on that black line on that particular day. So today was a very aggressive up day. You can see we crossed up and through that orange line. And remember, we have had way more volatile trading here recently. It's part of the reason I like showing you guys this on these bigger days, because you can just see with your eyes, if you were to kind of look at this general area that I'm circling with my mouse off to the right-hand side here, how aggressive both the up days and the down days have been compared to a similar time period like right over here, where it was awfully quiet and we barely even had any 1% days, let alone 2% days like we're experiencing now. And we nearly had a 3% down day here on March 7th, where it almost got to that pink line right there in that particular case. So it has been more aggressive. It's been obviously a lot more volatile. Today, I should note as well, is I believe today is the first day we closed below 30 on the VIX in quite some time. Let me just pull up the VIX chart itself, because I'm curious for myself if that is the case. And you can see that we have up here, now I'm kind of focusing my attention up here, not down below, but up here is actually charting the VIX out. And on this candle, we actually went a little bit lower on an intraday basis, but we closed that candle at 30.75. The day before that, the close was at 30.23. Over here, the close was 30.48. So we'd have to keep going back probably to this candle right here. On that day, we closed at 27.59. So if I'm not mistaken, today is the first close for the VIX below 30 since February 25th. That is a long stretch of time to be consistently above 30. Typically in the past, you can see we would go above 30 for a few days, we come right back down. We might go up to 30 or thereabouts like we did right there, come right back down. Similar to back over here, and even really over here at the end of January. We didn't stay above 30 all that long. So that did make this most recent time period a little bit different than what we had been traditionally experiencing. We did stay above the 30 line on the VIX for a very long time. Let's see how many trading days that would have represented. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days in a row we stayed above 30, and now today we're back just barely below it at 29.83. For those of you that are newer to the VIX, just a reminder that it usually works inversely to the markets at large. So when the market is up big like it was today, the VIX itself falls, and then typically vice versa as well. If the market is down big, then the VIX is up a lot. So anyway, we've been in a more heightened volatility, era here more recently. And if you didn't notice it when looking at the SPX, just to eyeball the length of these bars over here, then you certainly know it by just simply looking at the VIX and how often it's been above 30 here and consistently recently. All right, let's go ahead and get into our normal 4-grid view now, and this will be chart 4B. And as we're looking at chart 4B, you can see here that today did put in a decent effort towards potential reversals. We always got to be careful with that because we have to remind ourselves the reality of the situation is all 4 of our charts remain below a falling 30-day moving average, and therefore the path of least resistance continues to be to the downside. But we're looking for kind of green shoots, as they sometimes refer to them as, optimistic little seedlings that you just never know might grow into an oak tree at some point down the road. And at least we have some little sprouts coming up here after a big day like today. Now, I'll be honest with you, I didn't personally think today was as rip-roaring to the upside as it could have been. In other words, the selling has become extraordinary here recently. We've seen growth stocks down 50, 60, 70, 80, some cases 90%. I mean, extraordinary beatdowns in the growth stocks. And it's nice to see an up day, especially a consistent one like we saw today. We're over, 88% or whatever it was of the components finished higher. But in an environment where we've got stocks that are down 70 and 80%, to have our big, reveal day like we had today where the market just rallies furiously, to have it only up 2%, I think is a little bit of a whimper. If it was a 2% move out of nowhere at the end of last year when we had a lot of, quiet trading sessions preceding it, perhaps that's a different situation. But considering the aggressive selling that we've seen in recent months, today was not particularly noteworthy. In fact, to put that into context a little bit further, you'll notice the size of today's candle on the S&P 500 and then compare it to this day over here on February 24th. February 24th was a more aggressive day from high to low, and I think you can make the same claim as over here as well, that January 24th, what I referred to at that time as the flush the toilet moment, where you got a lot of the weak hands out of the market and then it rallied furiously and it started with that long lower shadow right there. If you were to kind of fill that in from low to high with a full body like we kind of had here today, that would have been a larger range back then, just like that day was. So was today an impressive day? Yes. We don't want to take it away from the market, but I will just kind of reiterate that I would have actually wanted more. If I really thought this was the end, like this was the bottom of the market, then I would have wanted a more aggressive day than a 2% day. So, because it still kind of gives you seeds of doubt that, yes, it's good to see us kind of, catch a little bit of a dead cat bounce here. Stocks don't go down every day, just like they don't go up every day. So you need to kind of balance things out, and today might have been one of those kind of balancing types of days, but it didn't really give me the impression that we're done with this yet. And that's the mindset I want to have, right? I tend to focus on the long side of the market as a long-term investor personally. So while I do plenty of bearish trades in these presentations like Microsoft and Danaher and those types of things, I as an individual investor would love to see the stock market go up more often than it goes down, but I'm also realistic towards that and understand that that's just not how the market works. And so for me as an individual, I would love to tell you that, hey, that was the bottom and we're just, nothing but glorious upside action from henceforth. But I just didn't actually get that impression here today. And I hope I'm wrong. I would love to be the first to admit to you that I was wrong in a situation like that. But it does not feel like we're done with it. And so that means we need to continue to earn our keep through these more difficult periods here in front of us. If we start trading above those moving averages for a longer period of time, then we can talk. At that moment, then I'm willing to kind of consider the possibility of a reversal to the upside. But until we do that, I just have to believe a day like today is more of a whimper as opposed to some big breakout, once in a generation type of a opportunity or something along those lines. So in other words, don't make too much out of what we saw here today. It was par for the course because we bled off too many profits along the way. Today was one of those where you got some of them back, but it doesn't mean we're out of the woods yet. So what it does mean is that we do have some posture changes. Let's talk about them. You can see here the S&P 500 now has a weekly bullish posture. So that background color changing to that light green color suggests that. And the reason for that is that green intermediate line down below on the market forecast indicator has kind of curled a little bit higher now. You can see that it was basically right at or in the lower reversal zone here yesterday, and now it's kind of curled a little bit higher and wants to kind of get out of it. And so while you're between 20 and 50, we consider that to be weekly bullish if the indicator is rising as it is right now. So that's the territory we're in. If we get above 50, then this background color will turn dark green, and maybe we can see some more consistent bullishness after that point. But until then, I'm just going to remain a little bit cautious around that prospect. And if it happens, it happens. I'll be happy to benefit from it with my portfolio. But my mindset is that we still haven't crossed that chasm, so to speak. Over here on the Dow Jones, same type of a thing. But it was a little bit different in that the Dow Jones actually went to weekly bullish yesterday. You can see it's kind of the same thing where the green line was rolling over, went into the lower reversal zone, now is emerging out of it and rising. So it's similar placement to where the S&P 500 was. It's just that it had a one-day head start, and you actually got that signal yesterday. Today was a good sign that, it confirmed that signal knew what it was doing, so to speak, here yesterday, at least in the immediate short term. We'll see if that continues to be the case or not. And then down below here, you'll notice on the Russell 2000, it also went to that light green background color here today. Similar to the S&P 500, today was the day that it changed. And you will notice that it had kind of a long lower shadow here today, a little bit different than the S&P 500. S&P 500 started low, ended high. Russell 2000 started somewhat high, sold off in the middle of the day, and then rallied back in the second half of the day. And so that gives you a sense that the bears wanted to take control of the market action, but the bulls wouldn't let them today. And so that's generally perceived somewhat bullishly, especially if those long lower shadows happen at support areas. Remember, it's a little bit of a different feel if they're happening up at resistance areas. Then they're kind of known more as hanging man or that sort of a candlestick pattern. But down here, they're closer to hammers. And you'll notice that we had another hammer over here where you had that long lower shadow. You had another one right there. You had another one right there. So could this be a meaningful candle today? It could. Those other areas did show that we were near some bottoms. And as I've been pointing out to you guys many times in the last several weeks, at least with the Russell 2000, it's been a little bit more impressive because they have not breached to new lows in this most recent rollover here. We still have the lowest level on the Russell 2000, kind of back to this candle on a closing basis back on January 27th, and then on this candle here on an intraday basis. And we didn't breach those lows on this most recent rollover here. Whereas on the other charts, we were breaching at least the closing lows, if not the intraday lows. So in other words, the Russell 2000 is hung in there a little bit better than some of these other areas as well. And so while we spent maybe 2 or 3 days above that moving average there, it ended up being somewhat similar to what we saw over here. It just couldn't hold it. So that's why I always say, be careful getting too ambitious too early, because a lot of times it takes work and it takes time. Sometimes people just want the selling to be over with and we're off and running. And perhaps, for those of you that are newer to the markets, you are trained to think that way because of what happened in March of 2020, where we had this immense wipeout followed by the fastest recovery in all-time history. But when I say things like all-time history, that should remind you that that is not normal. So you might have been trained that way if you've only been trading for a couple of years, but that is certainly not normal. Much more normal is a long, drawn out affair before we have an actual trend change take place. And that's kind of what it feels like we're going through right now. So we'll keep our eye on it. It's good to see that Russell 2000 continues to be reasonably strong, back to that weekly bullish posture, but we do need it to get back above that moving average and spend more time above it than just 3 or 4 days or whatever it was that we saw the last time around. The NASDAQ is the only one that did not end up with a bullish posture at the end of today. So it was still a good day for the NASDAQ. In fact, the NASDAQ blew the other indices out of the water. It was up nearly 3% today, 2.92% to be exact. So it was a massive up day. But the problem is, you look at this chart and it doesn't really look like it, right? If you were to look at that candle there, you wouldn't say, oh wow, that was by far and away the biggest mover of the market today, unless you could also see the actual evidence in front of you. Because you look at that candle and it gets a bit skewed. It doesn't look bigger than, let's say, the one up here for the S&P 500 or even the one up here for the Dow Jones Industrial Average. The reason for that is it's a little bit of an optical illusion in the fact that the NASDAQ composite has been absolutely kicked in the teeth for a long period of time. And so your bullish candle today needs to be compared to those previous bearish candles. And while, yes, it's great to see that the NASDAQ was up 2.92% today, we're basically just back to where this thing was trading at the end of Friday's session, right? And that's a little bit of a different look than what we see with the S&P 500 and especially the Dow. Notice the Dow completely erased that loss from Friday. Where we closed on the Dow actually brings us back from a closing price basis back all the way to March 4th. With the NASDAQ, we are basically just back to the closing prices of Friday. So we've got a lot more work to do there, and it's going to require a much more aggressive rebound, which is why you see the type of rebound you saw today, but it didn't actually impact the trend. We are still in a downtrend for that growth stock-laden NASDAQ composite. We did have an oversold cluster signal yesterday on the NASDAQ. I'm sure David probably pointed that out when he did the video for you. So I think that, bodes a little bit better for the NASDAQ as well, because things got so oversold that we might be due for a bit of a snapback rally. The real question is, does it actually result in a trend change? And right now, I am thinking the answer to that is no. And I'll be happy to be wrong about that. But right now, I have to make the assumption that the trend holds and we continue to struggle in the foreseeable future, even if we get a nice bullish rally in the immediate near term, let's say in the next week or so. You will see that the S&P 500 was up 2.14% today. Dow Jones was up 1.82% today. NASDAQ Composite up 2.92% today. And then the Russell 2000 was up 1.4% today. So 3 out of the 4 back to weekly bullish postures. 1 out of the 4 remains in strongly bearish posture. All 4 of these remain below falling 30-day moving averages, which means we've still got a lot of work to do. Let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these market outlook related posts on social media, especially on Twitter, where I tend to hang out much more so than the other social media avenues. And so I always say, as long as you're giving me 100 likes, I'll plan on doing a full-length video for you the next time I do the video, as long as I'm in the office. And so obviously you guys gave me 106 likes last time around, which means I'm doing a full-length video for you here today, including a trade application example. But as I mentioned before, I'll actually be out of town, out of state here in the coming days, and so I won't be around to do the video for you guys on Thursday like I normally would. David is still going to be in town teaching his classes and doing all that kind of stuff, so I imagine you'll still hear from him when he's typically scheduled to do the Market Outlook video, which is Wednesday and Friday. But Thursday this week, no video. But I do appreciate those of you that clicked like for me the last time I did the video last Thursday. Thank you to Tom and Kenneth and Adrian and Braun and Deborah, Sedona, Ron, Doug, Michael, Evan, Margie, Jim, Nick, Irene, Claire, John, Ann, Roger, Lucius, Dale, George, Duncan, Kirk, Serene, Ray, Surendhar, Marty, Prickly Trader, John, Dave, Carl, Ken, Phil. Too many to go through here, but I see you. I see you and I appreciate you. I see you guys' notifications coming through, and I know you guys are doing your part to help support this Market Outlook presentation, which helps incentivize David and I to keep on bringing them to you as often as possible on YouTube. So thank you very much. Please continue to keep that up. So far, so good, by the way, on the Corteva trade. I was curious about it here today, with today being a day where it was kind of an opposite day, and a lot of the commodities, especially the oil companies, were getting hammered here today. I was wondering if Corteva would suffer that same fate, but fortunately, the agricultural-related stocks kind of were able to get a hall pass for at least one day. We'll see if that keeps up. So far, so good. That trade's been working pretty nicely. Let's go ahead and also take a look while we're over here on the internet at the sector selector. So remember, this was put together on Friday, so it's a couple of days stale by this point. And by the way, housekeeping note on that, I typically do that Friday nights, but again, since I'm going to be out of the office here for the next several days, like I told my students on Monday's class, I'll get this updated this week on Sunday night. I am planning on being back in town Sunday night, and I'll make sure that I do my best to get that taken care of for you guys before I go to bed on Sunday night, and then we'll still be in class like we normally would to evaluate it on Monday morning for top-down trend trading for those of you that are my premium members out there. But anyway, as you can see here with the sector selector, energy did stay up at the top at least through Friday night. Obviously, I'm emphasizing that this time around because the last 2 days, energy stocks have kind of sold off with oil prices starting to kind of pull back in once again. So my gut feel right now tells me that energy will remain on top despite the selling of some of those oil stocks. And the reason for that is the energy stocks had such a massive built-in advantage over all the other sectors that they can afford to give back some pretty wide swaths of previous performance and remain up at the top of the ranking system based upon relative strength. Number 2 was utilities. Especially natural gas utilities have really picked up steam here more recently. So keep your eye on that area, because for the last couple of years, the natural gas utilities had been amongst the most out of favor utility areas. In fact, that's why we had concentrated on them as often as we did in my dividend growth investing class. Remember, in that class, we like to buy stocks when they're down and out with the hopes that eventually their prospects will turn around. And so now we're enjoying the good benefits and the wisdom of having bought those natural gas utilities in the last 2 years, because now they are amongst the leading utilities as commodities have kind of gone to the forefront of investor attention once again. Materials in the number 3 position for obvious reasons. Remember, that's where you're going to find a lot of the gold miners and the palladium miners and the copper miners and all those types of companies, including the agriculture commodities or chemicals plays, like CF Industries and potash, and some of those types of companies are going to be in your materials space. And then a little bit of a surprise here with real estate coming in at number 4. This is actually the highest positioning of real estate since going back to 2021. The final week of 2021, it was up there at the top. And then the very first week of 2022, it fell down to the number 6 position, and it hasn't advanced any higher than number 5 since that time up until this week. And this week it is back into the top 4 that we like to look at in my Monday top-down trend trading class. And the real question is, who did it replace? And it replaced the consumer staples. As I was mentioning to you guys last week, we were kind of witnessing that in real time. And that was those days when we were noticing that, stocks like Pepsi and stocks like Coca-Cola and Philip Morris International and Mondelez, all those companies that are multinational companies that have some exposure in Russia, decided to close the doors on their Russian operations in many cases. And of course, their stock suffered. Remember, there is a consequence to making decisions like that. A lot of people just assume, well, that's a smart move, get out of Russia. Well, keep in mind, from a profits perspective, it's not guaranteed to be a smart move because you're probably having to continue to pay employees. You're still paying for the land there and different things like that, and you're just basically cutting off your lifeline in terms of future sales there as well. Now, most of those companies are well diversified and have lots of operations in other countries around the world, but it is a reminder that while it feels warm and fuzzy to make a statement and say we're getting out of Russia because we don't agree with what they're doing, that there is a penalty that investors have to pay when that happens. And so we'll see. Like I mentioned last week, it is perhaps one of those things where you do want to rip the Band-Aid off earlier in case it kind of bleeds over to even worse conditions in months to come. But in the immediate short term, that does result in suffering stock prices, because it means that a lot of that business will be having to be written off and losses kind of assumed for operations in Russia. So I think that had a big impact on consumer staples here in the last couple of weeks. What's also affecting them negatively, of course, is input costs. And as commodity costs are rising, then all of the grains and the metals and the oils and all that stuff that goes into producing an end product that is eventually sold to us consumers, if their input costs are going up, then those companies have to decide whether they're going to raise prices for consumers or not. Some of them might have an ability to do that if they offer a very attractive product, but others may not be in that position, right? They might have a more basic product where they say, well, if we raise prices on our product, our competitors are going to steal all of our clients, right? So it's not quite as easy as it might seem at first blush, and I think you're probably going to see profit margins under pressure for a lot of those consumer staples companies moving forward. We actually talked about consumer staples companies here in my dividend growth investing class today, where we got the opportunity to buy a consumer staples company for the very first time in the 4 years that David and I have been teaching here at Market Scholars. This particular company that I'll reserve my further comments on, because I don't want to spoil the surprise for those of you that will be watching the recording later on. But this particular company we did buy when I was working for TD Ameritrade. So I don't want to make it seem like it was just out of the blue, nowhere. But I will say that for the last 4 years, it is a company that we've wanted to own. We just have not had the ability to do so until we had a big enough pullback and its dividend yield became large enough to attract our attention. And today we got to cross off one of those really high caliber companies, that we have not up till this point been able to lock down in the last 4 years. So remember, for long-term investors, the last couple of months seem like they're a struggle for a lot of folks, but for long-term investors, look for opportunities, right? When the markets sell off, there will be babies that get thrown out with the bathwater, and it's up to you to determine whether they're worth picking up or not, and that's what we're here to help you out with in our premium classes as well. On the factor selector, this is actually fresh as of tonight. Typically, I don't post this to our website until Wednesday morning before my factor-based swing trading class. But with the circumstances where I'm going to be out of town starting bright and early tomorrow morning, I figured I'd just post it here tonight so that way you guys can check it out if you so desire. We didn't really have any changes on the overall rankings up above. They all stayed the same from the previous week. But one thing I did want to point out with some of the performance numbers underneath the hood is that we do see some strength here in this pink category up at the top on the 1 month look back period. And that is your low volatility factor. You can see the Invesco, BlackRock, Vanguard, and Fidelity versions of low volatility basically all closed in the top 6 of our rankings here. So all 4 of them in the top 6. You also had a couple of dividend yield category funds kind of intermingling in there as well. But the reason I'm pointing that out is when we've been reviewing this information in past Wednesday classes, that has not been what we have noticed. We have noticed other factors kind of creeping up towards the top, but typically not low volatility. So this is something that's a little bit newer here, at least on the 1 month look back period. 3 month and 6 month, a little bit of a different story there, but on the 1 month look back period, we do have strength in low volatility. And that probably goes back to what I showed you a second ago on the sector selector, where you see utilities up here in the number 2 position and real estate making its way to number 4, and even consumer staples and healthcare still being 5 and 6. Remember, those are your more defensive sectors that tend to come with lower volatility. And so the low volatility factor funds have been kind of part of the sectors that happen to be in the upper half of the sector selector as well. So all that kind of stuff kind of tends to work together there. So I found that to be somewhat interesting, but we'll get back in the saddle a week from tomorrow in my factor-based swing trading class to see if that will have changed along the way, but at least that's what we're seeing here in real time. All right, let's get back now on over to the charts on thinkorswim. Let's do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And as you can see here, we only have a handful of green charts, but they've changed a little bit since we've been looking at them more recently. The two on the bottom, the 10-year Treasury yield and the US dollar, have not changed. Remember, that was also the case when I looked at this with you on Thursday. But up here at the top, these two are different. We did not have green background colors on SPY or on EFA. Now, again, I need to stress, they're both below falling 30-day moving averages. So we don't want to make too much out of it. But we do have to ask ourselves a fair question. Did the developed foreign stocks tumble too hard in light of what's happening in the emerging stock world, right? We're kind of battling two different battles on two different fronts in the emerging stock world. Remember, the emerging markets are like your BRIC countries. That's an acronym for Brazil, Russia, India, and China. Of course, two of those BRIC countries are really struggling right now. Russia, for obvious reasons. In fact, they haven't even opened up the stock market there for the last couple of weeks. And then China has also really struggled here in the last couple of weeks as a result of a continued coronavirus lockdown. Here in the United States, we kind of feel like we're somewhat getting past it. Maybe we're being naive around that point right now. I'll let that be decided by others. But what I would say is it's not part of the conversation day by day the way that it once was, let's say 4 or 5 months ago. Today, the conversation is mostly about Jay Powell, and it's mostly about Russia, Ukraine. We're not talking all that much about coronavirus all that much. But over in China, they're literally shutting down cities like Shenzhen over there and impacting, manufacturing hubs and technology hubs and different things like that because it's becoming a bit of a problem over there all of a sudden again. And many of those Chinese stocks are getting absolutely decimated as a result. So it's no surprise that EEM remains with this dark shaded pink background color because they are in an absolute plunge right now, in terms of recent price momentum. EFA doesn't really give you that same feel. Remember, the developed foreign stocks come from places like Europe, Australia, Japan. And you'll see here that they originally tumbled on the Russia-Ukraine news. And there was some reasons behind that, right? A lot of the European nations are much more closely tied into the Russian markets than the US is. So we're kind of from the outside looking in at that. If you lived in Europe, you would know that there's significant amounts of your own energy sources that are coming directly from Russia. And if all of a sudden we're getting these sanctions on Russian assets and oil and things like that, it just complicates things. You also have problems with European banks that do a lot more business with Russian oligarchs and other important people in Russia. So you can kind of see indirectly why the developed foreign stock world did initially suffer. But notice the difference here in the last week. After getting those oversold cluster signals on EFA, we've actually had a pretty decent rebound here in the last 1 week. Whereas 1 week ago on EEM, we were actually higher. In other words, we've continued to fall in the last week on EEM, and we've actually gotten a bounce on EFA. So, perhaps that's another one of those green shoots that we might be looking for there. But again, we're still below a falling 30-day moving average, so we don't want to make too much of it. But at least there are some signs of hope that are starting to be established there in certain places across the globe. The other two I mentioned down below. US dollar was down just a touch today, but it remains close to a 3-month high. Of course, has that strongly bullish posture, trading above a rising 30-day moving average. And then what can I say about Treasury yields? I mean, this is just unbelievable. Treasury yields back to multi-month, in fact, probably multi-year highs here all of a sudden. 10-year Treasury yield is now 2.16%. It was interesting because they really broke down there for about a 2-week span here at the end of February, but man, just like a shot to the upside. they have just been relentless to the upside with very little in the way of give back along the way. And of course, the opposite of that means we've got bond prices themselves falling. And all of this is, of course, a precursor to what we'll likely hear tomorrow from Jay Powell is an increase in interest rates. So, we'll see if we have as many interest rate increases by the end of the year as what the market was initially projecting. But what we do know without very little doubt at all is that interest rates will be raised. It's just a matter of how much will they be raised. So it's going to be interesting to see how that plays out. But for the time being, just know bonds are in a world of hurt. Whether you're looking at TLT with U.S. government bonds, whether you're looking at BNDX with foreign bonds, whether you're looking at HYG with high yield bonds, they're just getting smashed right now. And there's not really a whole lot of hope in sight unless Jay Powell says something tomorrow that's a little bit more accommodative, a little bit more dovish, maybe backtracks a little bit on some of the aggressive language that might have been spouted out by the news media previous to that. But otherwise, it's pretty bleak there in the bond market right here, right now. Let's take a look here now at our Sector 12 grid as well. By the way, I should have mentioned this as well, touched upon it earlier, but just to confirm with your own eyes, oil prices were down about 5 or 6% today. Gold also struggled, but it was only down about 1.8%. But remember, crude oil has been moving a lot faster on both directions. So they're both kind of in approximately the same position where you had these big massive kind of almost parabolic types of moves here a couple of weeks ago where that has now been unwound. And look at where you find yourself, right on the upside, on the top side of that upward trending 30-day moving average. So in other words, this would be an interesting place to take a speculative bet on either some gold miners or on some oil stocks if you expect stabilization around that rising 30-day moving average. And you'll notice the last times we've approached those 30-day moving averages on gold and oil, it did catch a bounce there. I'm not here to say that it's a guarantee it's going to happen again because every era is different. But if you've been patiently waiting for a pullback to get more involved in the commodity markets, you just got it. What are you waiting for? This is the moment, right? And maybe you have to use some stop losses in case you're wrong, but this is the pullback. It's right here. How many times do people say, well, I'm just waiting for a pullback, but it's taken off without me? Well, it's here. It's at your doorstep. It's just a matter of how you want to handle that moving forward. And a lot of people still anticipate an inflationary environment in front of us for the coming year. And if that's the case, you'd like to think that commodities prices are more likely to rise than to fall. They might not rise at the same rates that we saw as a result of the war, but in general, that increased cost pressure starts somewhere, and it usually starts with commodities. So in other words, if you believe inflation is going to be a problem for the remainder of the year, you're effectively saying that you believe commodity prices are going to go higher. And so you got to kind of pick your spots, so to speak, when you take those investments, because they can be like riding a bucking bronco. Well, that bronco just bucked a lot of riders off here in the last couple of trading sessions. Perhaps that's your opportunity to get back on and see how it goes for you. All right, let's go ahead and take a look at our Sector 12 grid now. And as we're looking at that one, this is chart 5C here. And as you can see, we got a lot more green here all of a sudden, so that's a promising sign. Again, wanted to point out energy in particular, right? These are the oil companies themselves as opposed to the price of a barrel of oil, but it's set up similarly. In other words, we had this big move higher where energy was going up day after day after day for a couple of weeks in a row, and now we've had that give back here in just the last couple of trading sessions especially, but look at where we stand right now on XLE. We are sitting right on top of the rising 30-day moving average. You can see that the last time that happened, back here at the end of February, it was a perfect time to reload the gun to the upside. And so we'll see if that, takes place here yet again with those oil companies. But obviously they were the worst performer today, as I highlighted on the heat map earlier. Energy was actually down 3.6% today, so it was a pretty healthy give back. Every other sector was higher today, but energy gave back 3.6%. So, very oddball type of a day out there. On the upside, we had a really aggressive mover here as well, and that was technology. Technology was up 3.36%. just barely beating out discretionary at up 3.35%. So in other words, basically 1 basis point better was technology than discretionary. But they're both right there with very aggressive upward movements today. But you can see the problem. Both of those charts are still in downtrends. If anything, the chart that's kind of catching my eye all of a sudden that wasn't before is healthcare. Notice in the lower left-hand corner here, healthcare didn't go up as much as discretionary or technology. It was only up about 2% here today. But look at the chart looking healthier for healthcare. In other words, we've stabilized much more. Notice over here with technology. We rolled over, we rolled over, we rolled over. Yesterday was the lowest closing price on technology in several months. Healthcare, yesterday was not the lowest closing price in several months. Yesterday's closing price was quite a bit higher than the closing price back here at the end of February and back here at the end of January. In other words, while other segments of the market were really struggling in the last few sessions, healthcare really wasn't one of them. And now that we've got this snapback, notice what's happening here. We have a dark green background color on healthcare, telling us that we have a strongly bullish intermediate posture. And we actually have a green moving average as well, if you can believe it. It's like spotting a leprechaun this time of year. They're not all that common, right? We don't see them all that often. We've got one there, of course, with energy, and that has been the case for the entire year. Notice that energy with the very first day of calendar year 2022 started with a green line, and it has continued to be a green moving average that entire time period. In other words, price has closed above a rising moving average every single day in this calendar year for energy. More recently, we've also seen the 30-day moving average turn green for utilities, and they had a pretty decent day as well, up 1%, but that has been, something we've been talking about in the last week and a half or so as well. But otherwise, it's been bleak out there. All of the other sectors have not had green moving averages until now. Now we can include healthcare as part of that conversation there as well. So I actually don't mind that chart. If you're going to play kind of a reversal in the market and you really think we've got bullishness in front of us for the foreseeable future, then I do think healthcare could be a very interesting place to try to take advantage of that. So keep that one on your radar there as well. All right, let's get into our trade application example now. And for that, I wanted to go into the energy patch. And again, with the context in mind that we've had a big couple-day pullback here in the oil stocks, but they are still in an uptrend at this moment in time. They are still above their rising moving average. So when they pull back to that moving average, some folks might expect a bounce higher from that moving average, which could set yourself up for a situation of trying to be brave and buy stocks when they're getting clobbered, or do other bullish options types of techniques. And that's what I decided to do here today. So let me explain by coming on over here to, let's just look at chart 4A first. This is our market forecast chart, and I'm going to type in ticker symbol PSX. This is Phillips 66. What I did here today was I sold a put on Phillips 66. I actually used the May contracts here today, and I sold the $55 put, and I was able to get 1% return on risk for it, which is what I usually tend to shoot for. What that allows for is it allows for me to be wrong and still make money on the trade. I just can't be aggressively wrong. In other words, I got about a $20 head start from where we're at right now. And if it does get from 75 currently down to 55, I do believe that Phillips 66 is a rare stock within the energy world that is trustworthy around their dividend itself. Remember, that's not an easy statement these days because of the volatility in that sector over the years. But Phillips 66 does have a good history of raising the dividend. And so obviously here at this level, it could be perceived as somewhat attractive. So if I were to look at the trade tab, I can see that on Phillips 66, it's yielding 4.88%. And again, we sold the $55 put here today for basically 55 cents was our trade price there. So the bid was 50 cents, the ask was 55 cents, so our mark right now is at 52. So we're not up all that much by the end of the day. Nonetheless, it does go to show you that that 1% return on risk is available out in the month of May if you're willing to hold it for a bit longer than you might with some of the others. I initially tried to look at the April contracts, but I wasn't really liking what I was seeing on the available contracts there, whereas I could get behind the mindset of the Mays. Even if energy is under pressure between now and May, the question I'm asking myself is, do I expect Phillips 66 to shave off an additional $20 per share in that time period? And my answer right now is no. Could it happen? Of course, anything's possible, but the bet that I'm making is that it won't. And if it does, then I think its dividend will be mighty attractive. It's already at 4.88% in real time if you were to buy it right here, right now. But if you wanted to kind of figure out what your adjusted yield would be if you would need to take ownership at $55, for those of you that are newer to put sales, it's basically putting you on the hook for buying 100 shares of that stock at the strike price that you've selected. Up front, you receive a credit like we received here today with the $55 that came into our account. Now we're on the hook for buying 100 shares of Phillips 66 at $55 per share if it closes down below that level in the middle of May. But if you were to take their current dividend amount, which you can see here is about 92 cents per quarter, annualize that by taking it times 4, they're going to pay out at the current rate $3.68 this year. In all likelihood, they'll probably raise it later on as well. But for right now, let's just assume $3.68 will be paid to investors for Phillips 66 in the coming year. We'd take that annualized dividend number, divide it by, let's call it $54.45. Now, the reason I've got that number is, remember, we're on the hook for buying it at $55 even, but we took in 55 cents to start the trade, so you can kind of lop that off to give you your true break-even price, which in this case, 55 cents lopped off of $55 is $54.45. And that equates to a yield of 6.75%. So the question you're asking yourself is, do you think that Phillips 66 is going to have a dividend yield of 6.75% in 2 months from right now? My answer to that is no. And again, I acknowledge anything is possible, especially in a very volatile area like commodities. But given the inflationary pressures we're all dealing with right now, I'd have a hard time personally believing that that's going to, happen. And if it does, then what I know about it right now is I'd be happy to take a stock into a portfolio that's offering me a 6.75% dividend yield out of the gate. Heck, even if it went zero, if it went nowhere for an entire year and you're only collecting the 6.75% yield out of it, that's a decent return right out of the gate. Remember, the stock market usually only returns about 8 to 10% on an annualized basis. So if you started off your approach with 6.75% of that coming directly back to you in the form of a dividend payment, you're on your way there, right? You don't need much more price action after that to have a decent result as an investor. So anyway, thought we would take advantage of the beatdown that the market itself has taken here today by doing a bullish trade on one of those commodity areas there. Now, you'll notice on the chart, we also have a green dot showing up, and that shows up here on the daily candle chart because we have the blue, the red, and the green lines on the market forecast in the low reversal zone on the same day. That usually is a sign that the selling has gotten a little bit overdone and we're probably due for at least a short-term rally or at least stabilization in the stock price. So that kind of helped incentivize me here on doing the sold put on this one today as opposed to other oil companies that I was also looking at. The last thing that I'll bring up here is chart 2A. Again, this is the one that was just updated here earlier today on our website. So they've got the new calculations now because remember, the average high yield and average low yield calculations change every year. So that's why it's important for you guys that are premium members to import the fresh charts every year as well. But on Phillips 66, you can see it's already in the blue zone here as well. In other words, we would perceive it as being reasonably attractive on its dividend yield basis already here just at $75, let alone alone if it were to fall down here to 55, where I'm now on the hook for buying 100 shares if it gets down there. If it doesn't get down there, then the credit that I received today is mine to keep and to do whatever I want with. If it does fall to that level, then I have to buy it down there. And you can see it kind of stabilized around the $50 to $55 range back here during the lows of the coronavirus, and then again in October of 2020. So I think that can kind of help the chances of this trade to a degree there as well. Okay, so that's what I had for you. If you appreciated the video tonight, I ask one simple thing out of you. Help support this presentation by clicking like for me there on Twitter. A reminder that I will be out of the office for the remainder of the week, so I won't be teaching my classes, taking a few vacation days, enjoying some college basketball, and there will not be a video on Thursday as a result, but I will plan on being back with you next Tuesday. So until then, I want to wish you all the best of success with your trades and your investments. Enjoy the basketball tournament, have fun with St. Patrick's Day, and we'll see you all later. Take care, everybody. Bye-bye.